This next section will cover the retirement types, plans, options, and the distribution options available to you via the defined benefit and defined contribution plans. As previously mentioned, PSERS plans are defined benefit and defined contribution. These plans are described under Section 401A under the IRS regulations. With the defined benefit plan, when you stop working for all PSERS employers, if you are vested, you're eligible for a regular or a disability retirement benefit. Now, there are two types of regular retirements. There are early and normal. Early retirement is a reduced monthly benefit, and a normal retirement is a unreduced pension benefit. And then there is a third retirement option, which is a disability retirement. Now, the disability option provides a higher monthly benefit than an early retiree would be eligible for. And this is because under disability, there is a medical condition that occurred while you were employed that's preventing you from continuing to work for your PSERS employer. Decisions you make at retirement are final and binding and will affect your lifelong income as a PSERS retiree. These decisions include whether or not to withdraw your contributions and interest, as well as selecting a monthly payment plan. When we say withdrawing any of your contributions and interest, we mean that you may wish to withdraw only a portion of the available contributions and interest. The more of your contributions and interest you leave in the account, the higher the monthly check would be for you, and the higher the potential death benefit would be for your survivor or beneficiary upon your death. Now, when you're within a year of when you're planning on retiring, 12 months from when you're planning on retiring, you should request a staff prepared retirement estimate from PSERS. The staff prepared retirement estimate will detail the different retirement options you have available and the scenarios of withdrawing your lump sum. Now, if you did have a specific withdrawal of your lump sum in mind, that is something that has to be requested with the retirement estimate. Otherwise, we show you the simple scenarios of withdrawing no money versus withdrawing all of your money on the retirement estimate. When you retire, if you choose to leave all of your contributions and interest in your PSERS account, you will receive a higher monthly payment than you will if you choose to withdraw any or all of your contributions and interest at retirement. Now keep in mind that you do not have any future access to withdraw your or control your contributions and interest when you leave it with PSERS. To be clear, PSERS allows you to withdraw any or all of your contributions and interest at retirement. You will receive a monthly payment from PSERS for the rest of your life. However, based on the amount of money you withdraw, your monthly benefit will be reduced. The more contributions and interest you withdraw, the more it reduces your payment amount. In some instances, for PSERS members class TE, TF, TG, and TH, if withdrawing all of your contributions and interest at retirement, this can result in the present value of your account depleting to zero, thus resulting in no monthly benefit available for you for your lifetime. PSERS will let you know if this applies to you when you apply for your retirement benefit. Any money withdrawn in a lump sum can either be paid directly to you minus federal taxes, or it can roll over to any tax-deferred account as directed by you. Now, direct payment to member. If you choose to have a lump sum paid directly to yourself, PSERS is required by federal law to withhold 20% and send it to the IRS for your federal taxes. Ultimately, you will be taxed according to your federal tax bracket. So if the 20% is too much or too little withholding, depending on your other income for the year, the difference is made up the next time you file your federal taxes. If you are under the age of 55 in the calendar year that you terminate your employment, an additional 10% early retirement tax may apply. You are responsible for paying the 10% tax on early distributions directly to the IRS. PSERS does not withhold this additional tax automatically, but you must pay it when filing your annual federal tax return. Now, for a direct rollover, if you prefer to defer federal tax and possibly avoid the 10% early retirement penalty, you can choose to roll over any portion of your contributions and interest into an eligible retirement plan. Taxes will not be withheld from any money PSERS sends to an eligible retirement plan as a direct rollover. The IRS has special rules about rollovers and distributions. When you reach your required minimum distribution age, you may not be able to roll 100% of your contributions and interest. PSERS will roll over only the amount allowed by IRS regulations. Now, after making your decision of what to do with your lump sum, the second decision you're faced with is which monthly payment option do I want to select. Now, this slide is showing you the single life annuity retirement options. Now, the single life annuity options provide to you, the retiree, a guaranteed check each month for the rest of your life, and then a potential decreasing lump sum death benefit for your beneficiary upon your death. Now, your beneficiary can be updated as often as need be during your career, and then also into your retirement if you selected a single life annuity. Now, the two single life annuities you have available are the maximum single life annuity and then the option 1. Now, the maximum option, the way it works is it gives you, the retiree, the highest monthly check you can receive under any of the options. Now, the maximum option giving you the highest check has a trade-off of little, possibly no, death benefit available for your beneficiary. The death benefit for the maximum single life annuity is tied to your contributions and interest, and that death benefit gets smaller each month as you get paid your pension benefit. And the second single life annuity available is the option 1. Now, the option 1 works just like the maximum. Guaranteed monthly check to you, lump sum decreasing death benefit to be paid to your beneficiary upon your death. But the option 1 provides a lower monthly benefit than the maximum would have provided. But the trade-off of you getting a smaller check is there's a much larger lump sum, still decreasing death benefit available. So the death benefit under the option 1 is tied to the full present value of your retirement account. So that death benefit, although much larger than the maximums, still gets smaller each month as you get paid your pension benefit. So under both of these options, depending on what you've selected, your monthly check is going to continue each month for the rest of your life. The death benefit that existed at retirement is getting smaller each month based on the monthly check that you receive. And when you pass, if there is any death benefit remaining per the option that you selected, a lump sum payment would be paid to your beneficiary and then the account closed. But the death benefit under both of these single life annuity options eventually is going to go down to 0. So you can most certainly outlive the death benefit for your beneficiary, but no matter how long you should live, monthly check will continue to you, the retiree, each month for the rest of your life. The joint survivor annuities provide a monthly payment for your lifetime and a guaranteed lifetime monthly payment for a survivor annuitant after your death. Option 2, joint survivor annuity 100%. Under this option, your gross monthly benefit is reduced based on your age and the age of your designated survivor annuitant. You may name only one survivor annuitant, and at the time of your death, your elected survivor annuitant will receive for their lifetime the same gross monthly benefit that was paid to you. Benefits payable to your survivor annuitant may be limited. In the event that you select a survivor annuitant who is not your spouse and is greater than 10 years younger than you, the IRS prohibits PSERS from allowing you to select option 2. Instead, you may wish to select a special option at the allowable percentage for your survivor, which we will discuss shortly. Option 3, joint survivor annuity 50%. Under this option, your gross monthly benefit is reduced. The reduction is based on your age and the age of your designated survivor annuitant. You may name only one survivor annuitant, and at the time of your death, your elected survivor annuitant will receive for their lifetime 1/2 of the gross monthly benefit that was paid to you. Change in option / designated survivor annuitant. Under options 2, 3, or 4, if included a survivor annuitant, You may name a new survivor annuitant and or select a different option only if your marital status changes or your designated survivor annuitant dies before you. PSERS will recalculate your monthly benefit based on your new option. If you name a new survivor annuitant, your benefit will be reduced based on your age as well as the new survivor annuitant's age. Depending on your new option and or your new survivor annuitant's information, your monthly benefit may be further reduced. If your survivor annuitant dies before you and you do not elect a different option, your monthly benefit will not change. Now, special rules applies if you are divorced. In the case of a divorce, the former spouse may not be automatically retained as your beneficiary or your survivor annuitant under Pennsylvania law, unless there is a domestic relations order which specifically grants the payment to the benefit to your ex-spouse. It is considered by PSERS as though your survivor died before you. If you wish to keep your ex-spouse as your designated survivor annuitant or beneficiary, you must inform PSERS in writing. Now, in addition to the 4 standard monthly payment options we just went through, a special option or a customized option is also available for you to consider. So if the 4 regular options that we just went through don't fit your personal circumstance, understand you have the ability to request a special retirement option, which is also a joint survivor annuity option, but it is a percentage that's not the 50 or the 100% of the option 3 or the option 2. So any percentage of your benefit can be transitioned to your selected survivor, and to request that specific percentage, you can request a customized or a special option when you request the retirement estimate. Now, a customized option would be available for anyone to request, but the customized option is of your own creation. That can be as complicated as having multiple survivors requested to receive a benefit in the event of your death. It can be guaranteed present value retirement options. A customized option is 100% of your own creation, where as long as the request is actuarially sound and does not violate any of the terms of the PA retirement code, it would be provided to you. But a customized option is something that has to be requested in writing to our central office when you're requesting the retirement estimate. Now, if you are leaving employment due to a physical and or mental condition, you may want to consider a disability retirement option. Now, the monthly payment amount of the disability benefit would be more than the early retirement would provide, because under the disability benefit, because of the medical situation, you receive an offset to the early retirement reductions you are faced with as an early retiree. There are advantages and disadvantages to the disability retirement option versus early retirement. And if you're in that circumstance that are mentally or physically unable to perform the duties of your current job with the district, please contact PSERS about the disability for more information on the disability retirement benefit. Now, to be eligible to receive a disability retirement, you must have at least 5 years of credited service. You must apply within 2 school years of your last day of paid service. Now, under the disability, you do not have the ability to withdraw your contributions and interest as you could as an early retiree. But again, the disability retirement is going to give you a larger monthly check than you'd be receiving under early retirement. And lastly, PSERS does not require that you resign your position with the district, just that you're in an unpaid status, such as an unpaid leave, to be eligible to apply. So if you are mentally or physically unable to perform the duties of your job, please contact PSERS about the disability retirement options that are available. Now, if you do have a defined contribution account with PSERS, upon termination, you have the ability to close out that DC plan. The distributions are available the later of 30 days after termination date is reported by your employer, or the last day of the month in which your employer reports your final work report. Now, if your balance with Voya is over $5,000, The distribution options are available as a full distribution, a partial distribution, establishing installment of distribution, or an annuity for the rest of your life of the distribution. Now, if the balance is $5,000 or less, 90 days to request distribution or rollover. Otherwise, if balance is 5,000 to 1,000, between 1,000 and 5,000, it'll be rolled over to a Voya IRA immediately. Or if the balance is less than $1,000, a lump sum payment will be sent directly to the member. Now, on the website, we have a publication under the financial wellness articles called Exploring Your Distribution Options. Then this is sent out with the termination notices that Voya sends. Voya cannot process a distribution until the later of the 30 days after termination date reported by the employer, or the last day of the month in which the balance of the contract is reported by your employer.